Alrighty, everybody. So I started this challenge about, I don't know, I want to say maybe a week and a half ago. I haven't traded every single day, although I show it to the markets every single day. I'm really focusing on only trying to execute on A plus and A setups, which, I mean, bro, depending on what strategy you're trading, you know, everybody's going to have their own level of conviction, also depending on your experience level. So the goal is to turn $5,000 into $20,000. Now, I know you guys will see a lot of different crazy challenges online, and I'm here to tell you guys is the reason why I'm not trying to go for a really large amount is because I'm trying to do something that almost anybody can replicate. And turning $5,000 into $20,000 in a very short time frame, it's not something that's very difficult to do if you have the right experience and the right edge inside of the markets, and that's what I set out to do. Right now, the account is currently sitting at $13,300. I should be sitting at around $15,000, but I ended up paying a ton of money in commissions on my very first trade. So then I ended up transferring over into a no commissions account, and now I'm paying no commissions, which is absolutely phenomenal. So what I want to go over today is the number one setup that I basically taken on this account that has really generated me the most profits. So once we do that, you know, I'll break down for you guys that specific setup and what to look out for on a daily basis to execute on that setup. And, you know, I'm going to show you guys also the profit and loss calendar and what my game plan is moving forward for this account. Alrighty guys, welcome back to another video. So I'm going to be going over the number one setup that has allowed me to turn my $5,000 order flow challenge account, which is my personal funds. I don't know why some of you guys think this is a funded account. This is my personal funds. And my goal really here is to turn it into $20,000 within the same month, which I started in August. Now, as you guys can see, my account balance is currently sitting at $13,343. And as you guys can see, the deposit was $5,834. No, I did not cheat. I did not deposit a little bit more. It's just I was trading previously on a raw spread high commission account that I didn't realize it, and I decided to do an internal transfer after having a huge winning trade that paid me almost nothing because I paid so much money in commissions to a no commissions account. You guys could see that my account balance is sitting here, that it's at $13,343. You guys can see the initial deposit here, and you guys can see it's also a live account. Now, these are going to be my stats. As you guys can see, my biggest red day is $291. My biggest green day is going to be almost $3,000. So more than 10x on my biggest red day. Total P&L is around $7,000 on this account so far, which is good. I've doubled the account using solid risk management. Now, this is going to be my biggest red day. It's going to be $803, which I ended up taking 2 losing trades in a row, and then I ended up taking a break-even trade, which an $800 red day compared to a $3,000 green day is not bad at all. And as you guys can see, I made that money back plus a little bit more on the following day. I have a profit factor of a 4.07, which is absolutely phenomenal. You guys can see I have a total of accumulated losses at 2,336, and then I have a total profit of around 10K. Now I have a win percentage of 60%, and I also have a weighed-in percentage, a winning day percentage of 75%, and a total realized R multiple of 3, which is absolutely phenomenal. You guys can see my equity curve here, which is super solid. And more importantly, the reason why you guys are coming to watch this video is the number one strategy that I'm using to actually grow this account, which I'm using 2 strategies. The first one is going to be a mean reversion setup, and the second one is going to be a low volume node continuation setup. Now, they're going to be 2 completely different setups. One is following the direction of the overall volume and movement and trend, if that's how you want to call it, and the other one is going to be a mean reversion. Now, for those of you guys who don't trade order flow, first of all, I highly recommend you start trading order flow and you stop wasting time, because you get an actual insight as to what the market participants are doing live on a daily basis. You don't have to completely switch your trading strategy. You don't have to completely learn a new language. These order flow concepts are Very simple concepts, but you just have to start learning them and implementing them into your strategy. It doesn't matter if you trade ICT, smart money concepts, if you fucking trade the dinosaur strategy, you need to implement order flow into your strategy right away, even if it's just a footprint chart or a volume profile. Now, the foundation of this trading strategy of the mean reversion setup starts with a volume profile. What a volume profile is, it shows us volume by price or volume at price. So we can see how much volume is traded at each one of these prices. The further away this is from the start of the trading day where the volume profile essentially starts means that there's more volume traded in that day. And on this program specifically, you can see how much volume was actually executed at a specific price. So if we look at the POC, which is going to be where the most volume on the day is traded out, you can see that there was 22,000 contracts executed at 6471.25. So all a mean reversion simply is, I want you guys to think about the mean as being value and where the market actually does find value at certain price ranges. So all value simply means is that this is where we see a lot of buying and selling activity going on and where a lot of volume is being traded at these prices. So if we were to look at volume profile, again, this is where the market finds value. This is where we see a lot of business being conducted in between this 64.79 and 64.69, 64.70 range. Let's call it here. This is where we see a lot of business being conducted. This is where the market deems as there's value in this area. Now we also have value up in this area here as well, which I'm actually going to change the colors to these. I'm going to make these, let's make them white. Let's also do this white as well, which that's actually my fault. Let me edit this, make it transparent. All right. So this is going to be where the market deemed and where the market found value in the earlier session of the market, because the market open is actually going to be on this one candlestick here, this big flush that we actually see. So this is where we found market, or this is where we found value in the pre-market, and then this is where we found value after. This is going to be in our regular trading hours over here. Now, essentially, after this big flush, if we look at this area right here, this is going to be considered a low volume node where we did not find any value. There was not much business conducted in this area. What a low volume node simply is in the markets, these are areas where we have gaps in fair value, or these are going to be real fair value gaps in the markets. Because if we just look at a price action chart, a lot of ICT traders will just mark up random fair value gaps after a little bit of an impulse in a single direction, which I'm not saying that's wrong, is I'm giving you data, and then what you guys could do is literally formulate your own opinion based off of that data. Where could you see where we have a lot of business being conducted in this market? Where can you see where we have a low volume node in this market? And the simple answer is you can't. Now, if we open up a volume profile, what we can actually see here is in between this range, we see a lot of business being conducted. In this range, we see a good amount of business being conducted. So we have two areas where the market finds value, but then we have a gap in that value. So one of the setups that actually trade is going to be a low volume node continuation. A lot of these prices just get rejected through, and this is caused, and why we have these gaps in value is simply caused by a lot of aggressive buying, or in this situation, in this example, it's caused by a lot of aggressive selling, to keep it simple. So once the market started to accumulate down here, what I also want you guys to pay attention to are technical key levels as well. So if we actually mark up our technical key level, it's going to be at 64.70, which if we go back in the trading view, we go to like a 30-minute time frame, you can see at 64.70, this is going to be our range lows. And you can see the range lows were faked out multiple times. But what do we also have at our range lows? We don't have any business being conducted in this area, and we're seeing the market reject these range lows multiple times. But just because we're seeing the market reject these range lows multiple times, that really doesn't mean anything to me. What really confirms this mean reversion setup for me, and really all a mean reversion setup is that, okay, well, you know what? We found value lower. We're starting to see price struggle to continue to find new value even lower than where we already broke out to. I want to see if the market will pull back into its previous area of value. As simple as that, to conduct business there. And we'll see if we form value higher, or if we reject and we form value lower and we revert back down into where we found value before. So again, you have to think about the market as an auction place, guys. And this is just like basic market auction theory. If I were to grab this iPhone right now and I were to list it up for sale for $2,000, nobody would buy it from me. So what do I have to do naturally to get this iPhone sold? I have to lower the price. So let's say I'm at a discount of 50%, and this is where we actually see people start sending offers for this iPhone. It's up to me to sell it at whatever that offer actually is. And that's kind of like the basics of just how supply and demand even works to begin with. And that's the same exact thing with the market itself. So when we actually get down to this mean reversion setup, really what I'm looking for here is, okay, well, if the market is holding up here, I want to see if we could revert back into where we found value previously. So the whole trade idea behind why I would take longs in the situation like this is very simple. Number one, we started to accumulate and find value lower, and we're struggling to continue to actually break out to the downside. Number two, if we do see trap selling down here and we see a potential reversal, I want to see if we could pump back up into this 64.89. That's going to be my main target. But does that mean that's where I have to get out of my trade? No, I can get out of my trade way before, and I'll show you guys why. Simply because of our multiple, from an R multiple perspective. The overall target would pay a 6R multiple, but I'm actually going to target 64.85. Why? Because that's going to be the beginning of this low volume node here, where again, if we push into this low volume node and we see a lot of buyers and we see a lot of buying come into the market aggressively, then what we're gonna see, if we don't see any reward for that buying, we have passive selling sitting in this area and volume dies off, then we're gonna see a reversal. And you may be asking yourself the question, it's like, hey, Raul, how do we even confirm that? That's simple. We use a delta footprint chart, or at least I use a delta footprint chart. Some people like to use bid and asks footprint charts here. So now the actual setup and the reasons why I took this trade here was very, very simple. First and foremost, the market faked out the low of day, which we created a low of day and we have a lot of trap selling. How do you identify the trap selling? Well, on a delta footprint chart, what we can actually look at here, and I'm gonna extend this heavily, what we can actually look at here is the difference between the buying at the ask and the selling at the bid. And the net difference is going to be the delta. So in this situation, we could see that there was a negative 108 delta, meaning that there was 108 more contracts aggressively sold at the market to keep things as simple as possible. So whenever you see a negative delta, think of sellers. Whenever you see a positive delta, think of buyers. So what do we see here at the low of day? We see sellers getting very aggressive. We see a negative 116 delta. We see a negative 108 delta, yet volume dies off. And what do we see? A reversal. And now we're starting to see a 160 delta, a 101 delta, a 178 delta. But now what we have here also as well is we have divergence. So notice that this cluster actually ended up closing bullish. And this is going to be a 5 range bar chart. This cluster, think about it as a candle, closed bullish. But we have a negative delta overall on the cluster. And this is going to be cumulative delta for the cluster itself. So essentially in this range that we have here in this candlestick, what the cumulative delta is, it's basically getting the net difference of all of the buying at the ask, all of the selling at the bid, and it's going to get the net difference of all of these deltas and add it up together, and we have a negative 134. So there was more selling in this entire cluster, yet we closed bullish. Raul, those are two different stories. What does that tell us? What that tells me is that we had passive buyers loading into the market as the market was coming down, filling those buy limit orders. And as those buy limit orders were getting filled into the markets, there wasn't enough aggressive selling to eat through that absorption in the markets, and we saw an overall reversal. Like right here, then and there alone, at the low of day and at the extreme and how we've reverted so far away from the mean, you can take an entry if you're feeling that aggressive, and the confirmation for you is there, but that's not the reason why I took this trade, because I don't like to be a first buyer or first seller sometimes. Now, what we see is aggressive buying come into the markets. Look at all these positive deltas. Cumulative deltas at 569. Look at all these positive deltas. Cumulative deltas at 1211. And then we start to see selling come back into the market at, let's call it 64.77, which is just near the high of this actual range itself. Now let's pay attention to this cluster. Look at all of this selling, negative 267, negative 233, negative 123, negative 101, negative 155, negative 91, and then a cumulative delta of negative 792. And what I want you guys to take into consideration at this level is not only at 6470, let's call it, which is going to be in this area over here. At 6470, we have the key level and we have the edge of value. So we're trading at a key level and we're trading at the edge of value. What happens on the next cluster? What we see is the next cluster opens up, immediately more aggressive selling comes in outside of value, and we have a negative 203 delta, negative 101 delta, negative 57 delta, negative 43 delta, right? But then price reverts and we start seeing aggressive buying come into the markets. So after seeing real aggressive buying come into the market, where you can see a 136 delta here, this is where I execute on the actual trade itself. Why? Because number one, we have price revert away from value. We're trading just slightly outside of value. That's not the real reason for entry. The real reason for entry in this situation is simply because we have trapped selling inside of this area after a reclaim of the key level of support and after we reclaimed back into value. What does that tell me? That tells me that sellers are really trying their best to try and bring this market back down. But we have large passive buyers, either one large passive buyer or multiple passive buyers, sitting inside of this range, literally just letting their limit orders get hit. And once those limit orders do get hit and those buy limits get filled inside of the markets, then we have them reload back on the order book and reload back on the bid, meaning that those passive buyers, either being old ones or new passive buyers, are continuously defending these lower price ranges, trying to push the market back up. Now, what's really going to push the market back up in this situation here are the aggressive buyers that come into the markets. You want to think about the passive buyers as just kind of like a wall, that they're literally just holding the line. The aggressive buyers are going to be the ones to actually lift the offer and lift the order book, because again, breakouts are caused by imbalances inside of the markets. So when we see buying imbalances, this is what's going to actually cause the market to go up. So think about you really want to just think about the passive buyers as just kind of being like that wall of defense, and they're continuously defending that position. And if we don't have enough aggressive selling and big aggressive selling to push us through, there will be a reversion when that selling pressure does dry up. So after confirming trapped selling here at this area of support, and then that's followed up by aggressive buying, that's the entry confirmation right then and there. Now again, before I take the trade, where am I getting in if I'm right? Or where am I getting out if I'm wrong? Where am I getting out if I'm right? I'm going to get out if I'm wrong under this trapped selling here, which is also going to be a little bit away from value and also under this key level of support. Solid stop loss placement. That is going to be a 12-tick stop loss. Take profit one is going to be 64.88. Does that mean I'm only going to hold to 64.88? No, that's ridiculous. It's horrible trade management. Why? Because 64.88 is going to be a 6R multiple trade. Like, it's super unrealistic to just try and hold to full TP all the time without covering your risk. I'm only risking 12, let's call it, I'm gonna be risking $100 on this trade to try and gain $600. If I'm floating $500 in profit, then essentially now I'm risking $500 to try and gain $100 on that trade. Why? Because if I'm up, let's call it 5R, which is going to be right here, meaning I'm up $500, right? I'm trying to gain one more R multiple. And if I leave my stop loss at break even, this is my risk for the reward I'm trying to get. That makes absolutely no sense, especially basing that we have a low volume node in this area, which if we look at this low volume node, we have the low volume node in between 54.85 and 54.88, and then we have the pre-market value here sitting at 64.89. So I'm targeting 64.89 here. But again, this word trade management is so important, and I see so many traders, and it disgusts me all the time, that they'll hold a trade. They're almost at TP. They're floating 3-4R on their trade, move stops to break even and leave stops at break even. And it's like, if you look at this situation here, who in their right mind would put $500 at risk? Because although you didn't close a trade, it's still unrealized gain. You could close a trade right now and realize that gain. And in this situation, it's like, okay, well, you know what? We have a low volume node at 64.85, and my main target, let's make it a little bit higher, an extra point higher. My main target is going to be 64.88 or 64.89 and price at 64.85, and I'm not managing my risk here. I'm just trying to get a full TP. If not, I'm going to break even. Like, you have a 0.3 R multiple. You have an insanely large negative R multiple because you're trying to risk your $500 at break even to try and gain an extra R multiple, an extra $100. It makes no sense to me. So for me, although yes, my take profit would have been 64.89 for a 6.5 R multiple, I'm gonna manage my trade and I'm gonna continue to allow this trade to run as long as my trailing stop doesn't get hit. Which, the way I like to trail stops is based off of the order book. When you actually see real strength inside of the markets and real aggression in the markets and a real move up, what you'll see is bids or buy limits reloading on the order book higher. So if we have, I'm gonna give you guys a random example here, and I'm gonna make this, let's make this green. So let's say originally at first, whoops, that's my fault. Let's make this green. Let's say originally at first we had, this is gonna be my entry, this is my target, and this is my stop. Let's say originally at first on my entry, this is where we had bids loading into the markets. The markets pumped up. What I'm going to want to see for me to trail my stop loss up into more profit, because I mean, at this point when price pushed up and I'm up 2.6 R multiple, I risked $100. I'm floating $267 in profit. I'm already break even. Like, I'm more than double my risk. But to give you guys an example of how I trail into profit, now let's just say bids reloaded on the order book higher, meaning that we have passive buyers trying to support the market higher here at 64.75.5. I'm gonna trail my stop loss to 64.73.5, just a point lower than that. That's how I'm gonna trail my stop loss up. And this was what allowed me to catch the majority of this move up into roughly around like the 64.83s, just because I decided to close into strength instead of into weakness, which is something that I like to do personally, and you get like the best fills that way. Either way, I'm going to keep trailing my stop loss up where these bids actually are, and I'm going to just trail them slightly under where those bids are loading on the order book. So that's how I like to personally trail my stop loss. But again, like, if you're just looking at trading view and you're just doing basic technicals and you're not looking at a heat map over here that has a DOM, or you're not looking at a quick DOM either as well, which I'm trying to show you guys here. It's not letting me, that's fine. Then that's something that's virtually almost impossible to do. But this is going to be one of the main setups that I've been actually trading that's allowed me to generate this profit here. And then the other setup is going to be a low volume node continuation, which is essentially the same thing. Like, my entries on all of my trades, I have to identify trapped buying or have to identify trapped selling. So now let's look at what happens. So at these 64.85s, this is where we have the beginning of that low volume node. Notice how this is where buyers are being most aggressive throughout this entire rally to the upside. I mean, look at how heavy these deltas are. 378, 93, 172, 185, 177. And notice how these positive deltas slowly died off. We had volume die off. This is literally like an A+++ setup. This is like, I should have foreported this setup here. To give you guys a random example, right? Look at how we see all of this buying in this market here. And it's the same exact thing. Sell limits are the defense here, but what's going to cause the market to break out lower is going to be aggressive selling. Every time aggressive buyers pushed up into this range, we came back down. So we could have been here for 5 minutes, 10 minutes or so, which if we look at a time frame chart, we spent roughly around, let's call it 6 minutes, 9 minutes inside of this area, and buyers were trying to break out higher. So for 10 minutes, we had aggressive buying, just try and break out higher and break through these 64.85s, but we had passive sellers on the order book just literally sitting there absorbing all of that pressure. And you can even see that like on a heat map itself here, which I'll pull up the heat map for you guys really quickly, although I'm really not trying to like complicate this, but this is at high 64.85. Look at these large purple numbers here. What that's going to mean are those are going to be bids that are actually filled inside of the market. So these are all sell limit orders. You can see how much sell limits that were sitting here on the order book, and look at the attempt from the buyers. The buyers could just not push us through that low volume node. So in a situation like that, I would immediately take the market short with aggressive selling, probably around here, around the 60.43s. Stops just slightly above this high. Target would be back down into the mean, which in this situation, our target where the sellers originally got trapped, which as you can see after some time, that was hit right away. So that's going to be the second setup that I normally take, is going to be a low volume node continuations after a breakout to the downside, after a breakout to the upside. I look for a pullback into that low volume node and then a continuation lower or a continuation higher, depending if I'm going long or short. But anyways, guys, those are the two main setups that I'm trading on this account that is allowing me to generate the profits on this account, and obviously my personal accounts too, but these are the only two setups I'm focusing on this account. Anyways, guys, I mean, I trade live and I actually trade these setups every single day. So if you guys want to trade live with me, join me on this order flow challenge, because I'm taking almost every single trade on the order flow challenge account, my 5K account, in the live room and calling the executions out live. Click that first link down in the description and I'll see you guys on Monday.